Good morning, I'm Chad Justice, and welcome to Market Monday for May 18th, 2026. The April Consumer Price Index numbers dropped last week, and headline inflation was hot. The numbers underneath it tell a more nuanced story, and for the first time in 3 years, the average American's paycheck is no longer keeping up with the cost of living. Real wages fell 0.5% in April and are down 0.3% over the past year. That's the first negative 12-month read since 2023. And on headline inflation itself, prices rose 0.6% for the month, raising the annual rate to 3.8%. That's the hottest reading since May of 2023. Core inflation, which strips out food and energy, came in at 2.8% year over year. And on paper, core looks better. The catch is core sits downstream of energy. A headline shock today passes through into core tomorrow via transportation costs, packaging, petrochemicals, and eventually wages. April's energy spike will keep feeding core inflation into the summer regardless of what happens next. This report piled on to the mounting argument against rate cuts. Coming into the week, the market was still pricing in cuts later this year. And after Tuesday, those cuts are essentially off the table now, with some strategists questioning whether hikes might come back into the conversation next year. And currently, the labor market is holding up, but inflation is moving the wrong way. That combination doesn't give the Fed much room to wiggle. Energy alone accounted for over 40% of the monthly increase. That's where the rest of the show is going. And as of Thursday, American crude oil is sitting around 101 a barrel. Foreign crude is around 106. Both are off recent highs, with foreign crude touching 114 earlier this month. And to put the move in context, foreign crude averaged 117 in April, the highest monthly average since June of 2022. Both are up more than 45% since late February, when the conflict in the Middle East closed the Strait of Hormuz. The mechanics of this shock are what make it different. Most people think about oil through the lens of demand. And when the economy heats up, demand pulls prices higher. This oil shock, however, is a supply crunch. Right now, roughly 10.5 million barrels per day of Persian Gulf oil production is offline. That number is expected to peak over 13 million as storage tanks fill up. And to put it into perspective, that's more than 10% of the global supply. Saudi Arabia just told OPEC its production has fallen to the lowest level since 1990. And on top of the decrease in production, the world is burning through the oil inventories at a record pace. Global stockpiles drew down by 250 million barrels over March and April combined, which is about 4 million barrels a day. And if the closure continues, the cumulative drawdown could approach 900 million barrels by September. That's unprecedented destocking. And the question that matters most for inflation is duration. How long does this last? The EIA estimates that flows through Hormuz will gradually resume in late May or early June. Even with that assumption, the EIA doesn't expect production and trade patterns to normalize until late 2026 or early 2027. The CEO of Saudi Aramco confirmed this view, stating that the strait staying closed past mid-June pushes normalization into 2027. And there's no quick path to normalization, even if a deal gets signed tomorrow. To pull it all together, April CPI isn't a story about a hot economy. It's a story about an oil supply shock doing two things at once. It's showing up directly in the headline through energy prices, and it'll keep showing up indirectly in core inflation for months via pass-through. Even if the Hormuz opens in June, inflation won't normalize overnight. The Fed can't add barrels to the market, and they can't shortcut the pass-through lag either. And that's why the conversation has flipped so quickly from when the Fed will cut to whether the Fed will need to hike. So, with all this data right in front of us, why isn't oil higher? Tune in next week for that discussion.